Now that we've completed the tracking for our equipment lease, Precision Industrial has thrown another contract at us. This time we've leased a small office space in Austin. So let's go through our 5 steps to account for this lease. A small spoiler alert, this will likely be an operating lease. But the good news is we can reuse most of the structure we already built for our equipment finance lease. Only a few minor adjustments will be needed, and we'll walk through all of those step by step. So here's the lease we've entered into. We signed the contract on January 19th, 2026. A few important items stand out. We've rented 2,000 square feet of office space in a 50,000 square foot building, and we have 15 parking spaces included. So step 1 is complete. We clearly have a lease under ASC 842. The office suite and parking spaces are identified assets, and as we'll see as we look through the lease, we have the right to obtain substantially all the economic benefits from and direct the use of both during the lease term. Then we'll skip item 2 and come back to that in a minute, and instead look here at items 3 and 4. Item 3 is simply the monthly rent schedule during the lease term. And you'll note that during the first 12 months, our monthly rent will be $3,800. Then item 4, the delivery of possession, states that we will be entitled to possession of the office on February 1st, 2026 if 2 things have occurred. 1, we've signed the lease, and 2, we've made our first $3,800 rent payment in advance. Then in section 5, you'll see this lease includes an option to extend at our discretion. So we'll need to evaluate whether we are reasonably certain to exercise that renewal option. But before we do so, let's first tackle any activity before the lease commencement date. Let's assume we're somewhere between the initiation on January 19th, 2026 and the commencement on February 1st, 2026. And our accounts payable team is making that initial $3,800 payment to the lessor. So here in our accounting system, let's assume we make this payment on January 23rd. We'll record this to prepaid lessor payments, just like the installation fee in our equipment lease. Then let's also assume we agreed to pay a broker $5,000 to help us find the space and negotiate the lease. ASC 842 requires us to include initial direct costs in the right of use asset, and a commission is explicitly listed as an example of an initial direct cost in 842.1039. So on the same day, we'll book this as a prepaid as well, this one to prepaid initial direct costs. So if we save and close this, and look at our balance sheet as of January 31st, 2026, the day before commencement, you'll see we have both our prepaid lessor payment and prepaid initial direct cost on our balance sheet. These will then get absorbed into the right of use asset when we perform our initial measurement on the commencement date and record our opening journal entry. With that complete, let's move on to step 2, separating lease and non-lease components. If we look at item 7 in the lease, we're responsible for common area maintenance expenses, or CAM. These are charged at 4% of total common area maintenance costs for the building, reflecting our 2,000 square feet out of the 50,000 total rentable square feet. This is a non-lease component because it doesn't relate to our right to use the office space. It's a payment for services the landlord provides over the lease term, so we need to treat it separately. Remember, we had very similar costs with our equipment lease, and in that case we elected the practical expedient to combine lease and non-lease components. But that earlier situation involved fixed payments. Here, CAM is variable, and we don't know the amounts at lease commencement. We'll be billed for 4% of total CAM costs, but the total fluctuates. Often in these situations, the landlord will provide and invoice us for a monthly estimate, and then true up at year-end once the actual CAM costs are known. Because these amounts are variable and not determinable at lease commencement, we will not include them in lease payments for purposes of measuring the lease liability. even if we elect the practical expedient to combine lease and non-lease components for building assets generally. But even though this won't affect measurement, the practical expedient still matters, because it affects how these CAM charges are classified and disclosed. If we do elect to combine lease and non-lease components for our building right-of-use assets, the CAM charges will be treated as variable lease costs, which, as we'll see much later in the series, are required to be disclosed as part of our ASC 842 lease disclosures. If, on the other hand, we choose not to elect the practical expedient, we'll treat these CAM payments like any other operating expense, and they'll fall outside the scope of ASC 842 entirely. So let's assume our policy is to elect the practical expedient to combine lease and non-lease components for our building right-of-use assets. That election will have no impact as we perform our initial measurement, but we'll need to remember it as we perform the subsequent accounting for this lease and look at our lease disclosures in the future. Then the last component-related question is whether the office and the associated parking spaces are one lease component or two. ASC 842 10-15-28 says an underlying asset is a separate component only if both criteria are met. One, we can benefit from it on its own or with other readily available resources. And two, the right of use is not highly dependent on or interrelated with other assets in the contract. This does require a bit of judgment, but here it's fairly clear we have one lease component. We can't benefit from the parking spaces on their own, and realistically we wouldn't be allowed to use them unless we're leasing space in the building. And even if we were allowed, the parking lot gives us no standalone economic benefit without the office suite. So under ASC 842, we'll treat these as one lease component and allocate the entire monthly rent consideration in the contract to that single component. And with that, we've completed our first two steps, identifying the lease and separating the lease and non-lease components. In the next episode, we'll move on to classifying our lease.